Hey everyone, Tom Gentile. Welcome to Tom's Trading Room, and today I want to do a quick video on looking at cheap and expensive options. Which ones right now in the month of December are the cheapest, which options are the most expensive, and which ones are actually tradable. That's what I want to do with you today. Hey, do me a favor, hit that like button at the bottom of the screen, just to the left-hand side. That helps support the channel. Also on the right-hand side at the bottom of the video, you will see a subscribe button. Subscribe that and ding the bell. You'll get videos like this as soon as we upload them. Okay, so let's go ahead and move forward. And again, I want to talk about trading cheap and expensive options. So the first thing I want to do is I want to look at the Vix Futures Chart. This is what we look at for the overall market to determine whether the market is cheap or expensive in terms of volatility. Then I want to show you how I find individual stocks with cheap and expensive options, and how I trade the results. And I do have one that is hitting a bullish indicator. I'm going to show you that in just a few minutes. So let's start with the chart of the VIX. This is VIX Futures as of present. Now, the green area, if I can mouse on in here, this is as cheap as the VXX futures have been. All right, VXX is the symbol for VIX Futures. This is the how cheap they were back at the beginning of the year. This was the big move higher in volatility when the coronavirus pandemic first shed light in our area. And then afterwards, we started seeing those VIX Futures drop. Now, importantly, very important is, where are they right now? They are very close to the lows that we saw at the beginning of the year. All right, now, what I can do is I can find this, where the cheapest, the most expensive, and current options are on individual stocks. And I can do that within Tom's Option Tools. So within Tom's Option Tools, I have an area where I can go to in Options and actually look at what we call pre-computed scans. I'm going to share the current ones with you right now. So these are the cheap options over the last year. So think about this. I live in Florida. It is as cold right now as it has been for the majority of the year. I think for us, the temperatures are going down into the high 30s tonight. And, most of our high temperatures are in the 90s to even 100. The lows can get down into the 30s, and that's where we are right now. So think of my temperatures in Florida very similar to these options. These options, if you take a look at night transportation, for instance, the high, the highest the volatility has been in the last year has been a 90.53. The low has been a 32.17, and the current is 33.66. So if you get an idea, you can see that we're just 3.83% off of the lows. This is very close to the lows. Kenmore's company, same situation. It had a high of 255 on the IV, a low of 50, and we're currently trading over 53. So it's only 6.24% off the lows. You can see that as you go through every one of these, and we're seeing cheap options right now in things like, for instance, if I come down, we'll start to see some stuff we really notice. Peloton is as cheap as it's been in almost a year. Roku is as cheap as it's been in almost a year. Switch is on that list as well. So there's a couple of stocks whose options are cheap, and these are popular stocks that you and I know and possibly trade on a regular basis. Now, let's take a look at the most expensive options, the ones that are closer to the higher side. And for that, I've got to turn around and look at our expensive over the last year using IV percentiles. All right, now this just switches the strategy up, and it shows you how far off the highs we are. So MicroStrategy, number one. 121 IV on the high side, 21 on the low, and 121 on the right now currently. So it is only 0.3% away from its yearly high. All right, look at Costco. This is number three. Costco, its high over the year was 73.78. The low was 13.78, and currently it's at 52.85. So it is trading very close to its highs as well. Now, let's look at some other companies that are popular when you see them. Moderna is on here. Obviously, they're high because they're part of the COVID vaccine area, and so that's going to be high. Salesforce is on this. DocuSign, CrowdStrike. Come on down, you can see Marvel Technology. Now, I have that one in green because I'm going to talk about it in just a moment. Xilinx is on here. Come on down and you can see that Five Below ends out the top 20. These are the top 20 optionable stocks in terms of being expensive over the last year. Hey, this might be a fantastic time to let you know that if you're new to Tom's Option Tools, there is a 2-week free trial below this video in the description. Just click on the link and you can have access to our Option Trader, Contrarian Trader, or Complete Trader absolutely free for 2 weeks so that you can do the things that I'm doing right here on this video. All right, let's get back to work. Now let's talk about MRVL. So MRVL, I highlighted it green for a reason. MRVL is a money calendar buy, and that is happening today through around January 11th. So between December 3rd and January 11th, over the last 10 years, this particular company has had a 90% accuracy in terms of being higher during this time frame over the last 10 years. 9 of the last 10 years, this 28-day trade has gone higher. It's also gone up an average of $8.89. 9 of the last 10 years, the pattern has actually gone up. 2015, the pattern was down. Look at last year, though. Last year, it went up almost 3 percentage points, $3, which actually equates out to be around a 10% move. What can we do to take advantage of expensive options over the next, say, 28 days? All right. Well, you're already probably thinking either spread the options or you could even potentially sell puts. Both of those two strategies are used when we have options on a stock that we like, all right, that trade a little bit higher than normal. So let me show you the options. And we're now looking at, this is off of tomsoptiontools.com, MRVL's options that expire January 15th. These are the calls on the left-hand side. These are the puts on the right-hand side. I have highlighted a couple of different areas. And while this is not a recommendation, I'm really teaching you how I think in terms of after I've spotted an opportunity, what's the best option strategy to take. In this case, what we did was we looked at the options first. Right? And in the term of expensive options, we already know what strategies we're going to do. We're either going to look at spreads or we're going to look at selling premium. And from there, I just look to see, are there any stocks that are in the expensive category that have some sort of a reason to buy? That's why I'm looking at the money calendar for MRVL. MRVL has a 47 call that's trading for just under $3. You might think, that's cheap. Well, it's really not, because that $3 represents 7% of the strike price. So we're going to need MRVL to move 7% just to break even. Why not take a move that's 7% and sell 7% higher to help fund the purchase here? So in this case, we could buy the lower strike call, sell the higher strike call, and then put a trade on that can be profitable if we hit 50. Another way to do it, maybe it's called a little more aggressive way, would be to sell the put options. Puts over here. And if we go out of the money, for instance, and we sell the 42 puts in January, this stock would have to go against us by 4.5 points to go from where it is currently down to 42 and make us buy the stock. Let's take a look at each of them in detail. We'll start with the bull call spread. So the bull call spread shows that if we put this on, we're buying the 47 for $2.99, we're selling the 50 for $1.86. I mean, we're talking about roughly taking almost 2/3 of this spread off when you do this. We're talking about what's this going to cost? $1.15. The red area is risk. If we're at or below this line by expiration, then we have risk. But we can have no more risk than the spread, what the entire spread costs, which is around $1.15. The reward happens if we're above our strike price, and we actually get up there above the 150 call, then we're maxing out, and we're actually making that $185 on that spread. So that's what a bull call spread looks like. Buy the lower, sell the higher. Right? Selling the put, it kind of changes a little bit. You got more green area than you do red. Much more green because the stock can fluctuate anywhere in this area, and you're still going to make money. If we're above 42, you're still going to max out money. If you go below 42, however, we start to drop on the curve. And if you get below what you've sold for, so you take the 42 strike and you back out $1.43, and you're talking about $40.57. You get below $40.57 and you're in the red zone at expiration, and that means there's a potential loss there. Okay, so in summary, the VIX or VXX is a great barometer, all right, in terms of forecasting and looking at market volatility, but it's overall volatility, so it's just a start. We can find individual stocks that have cheap or expensive options based on their past, and again, nothing is a guarantee, but I use this. And what I mean by this is looking at expensive and cheap options to determine the best approach to trading those options on those individual stocks. Guys, thanks for joining me. Hope you enjoyed it. Again, like this video if you can. It helps support our channel. And also subscribing and dinging that bell will allow you to receive these videos as soon as we upload them. Thanks again. Have yourselves a great rest of the week, and I'll see you soon. Bye now.